Hey, what's going on? Welcome back, everybody. I'm Travis here with JT Wealth, and in today's video, we're going to be talking about something that I've seen on Instagram and a couple other places for the last couple of days, and I wanted to talk about it. So I guess Michael Burry, the guy who called the 2008 housing market crash and was kind of the reason why the movie The Big Short was created, he has been talking about a pending FOMO-based market crash. I found some material based on the 1995, 2003, and 2009 bull markets talking about the historical precedent of times like these and what happened after. So let's see what history has to say about Michael Burry's claims. Alright everybody, like I said, welcome back. Thank you so much for joining me. Hopefully you find something of value in today's video, and if you do, please remember to give us a big thumbs up and consider subscribing to the channel if you haven't already. Hopefully you guys are out enjoying the weather today. It was like 97 degrees here in the Midwest today. I went for a run at lunch and it was like 93, so it was miserable, but a good time. Alright, so back to the topic of today's video. I don't think anybody can discount Michael Burry's genius and what he saw coming in 2008, so that's not the intent here. Rather, I'd like to showcase what history has to say about previous instances of a market kind of pumping up, going up roughly 40% or so in the tech spaces, and then having that decline for a consecutive few months, and then what happens after. We've seen the decline, and now we're kind of in that limbo phase, which is why he seems to think we're facing a pending market crash. But let's see what history has to say about it. But of course, before we dive right into that, check out the links in the description section down below. If you're looking to start a new brokerage account, I recommend Webull. If you're looking for a long-term investment or dividend account, I recommend M1 Finance. And if you just want to hang out, chat with like-minded people about finance, retirement, the FIRE community, whatever the case may be, check out the link to the Discord chat group via our Patreon. Alright, so check out this, guys. This came out on Yahoo Finance, and it was 3 historic precedents show tech stocks will go higher. Obviously, 2020 was a huge year for tech stocks. The NASDAQ composite was up 43.6% in 2020 alone. So it's perfectly normal to see a market kind of consolidate and even correct on some of those gains after such a big jump. But what happens after the consolidation and that little bit of drop from the highs? Well, as it turns out, according to 3 precedent years, there is another leg higher that occurs after this consolidation period. Now, it's important to note that we are talking about kind of the growth stocks, the tech stocks, not necessarily the S&P 500 as a whole, but the stocks that have seen the most growth and what they could potentially do. So let's take a look at the first example of this occurring. And that was the 1995 bull market. So you saw the NASDAQ composite jump up 40% for the year. And then after correcting close to 20%, the index accelerated into the great bull market of the late 1990s. You can easily see that jump up of 40% there, but then right around May, that period ended and you saw a correction of about 20%, right? But that next move higher started around September 1996 and accelerated through that great bull market of the late 90s. So it's not necessarily something that occurs immediately, but after that correction, they do see a leg up afterwards. And the second example of this is the 2003 bull market. So there's your 2003 bull market. You're looking at, again, a NASDAQ composite of up 50% for this specific year. And then after consolidating for 7 months, growth stocks such as Apple and Google began their mega runs. That initial peak of 50% ended in January of 2004. The next consolidation period of 7 months, then you saw around about September 2004, that's when that next leg up began. And the up move after that didn't get far into new high ground, but it was an excellent stretch. And that's when Apple and Google really pushed higher. And again, you're looking at something that pushed up 50% and then managed to not just stay up, but go up a couple more percents as well. So this is not something that crashes after it occurs, or at least historically. Alright, and the third example of a very similar instance was your 2009 bull market, obviously occurring after the 2008 housing market crash. So there's your 2009 bull market graph. This time the NASDAQ composite was up 44% for the year. So you're noticing a trend here. All 3 of these years were up 40% or more. And then after about a 4-month correction, the index resumed its advance with an over 30% gain into early 2011. And now this time you're seeing the advance begin again in September of 2010 this time, and it gained over 30% into roughly early 2011. And the growth stocks, a lot of whom such as like Lululemon and Chipotle Mexican Grill, they saw triple digit gains during that same run. Now you may be saying, well, what was the NASDAQ Composite's return in 2020? 42.58%. So it perfectly fits into this historical precedent and trend. And of course, when that roughly 42% growth over the last year peaked right around February, we looked at about 4 months of correction leading up to where we are today. So still to come is the Russell 2000 rebalancing that's going to occur on June 25th, I believe, and then normal end of quarter portfolio rebalancing that could have an impact on short-term movements of tech stocks. But overall, we're looking at the next leg up in the NASDAQ and for tech stocks specifically. And theoretically, they are saying that could begin as early as July as people start to anticipate the next round of earning reports. But all of this is just what analysts have to say about historical precedent and where the market stands today based on numbers. With the amount of liquidity in the market right now and the Fed continuing to keep interest rates at zero for the next year or so, I don't see a reason why there should be any significant hindrances to the NASDAQ and growth stocks and tech stocks as a whole continuing to power forward. So I don't know about you guys, but I'm starting to take a look at what tech stocks and what growth stocks I want to be invested in now so that I can take advantage of the growth that should undoubtedly be coming in the next couple of months. Whether that's your tried and true FANG stocks or semiconductors, medical stuff, software applications, or maybe EV chargers. I don't know whatever it is you're looking at right now, but there's so many things out there to start looking at. I read an article earlier today actually that was talking about 20% of California EV drivers get rid of their EV vehicle within the first year just because they have so much difficulty charging them. So maybe EV chargers would be a pretty good option. I don't know. I'll have to take more of a look into it. But that's pretty much it for today's video, guys. Let me know in the comment section down below what you think about this precedent, what you think about Michael Burry's comments, and where do you stand on tech and growth stocks or the market as a whole going forward? Are we looking at a pending market crash, or have we already seen the correction and now we're looking at the next leg up? Let me know what you think, and thanks as always for checking out my video. Until next time, bottoms up.
Okay, sit your butt down. Do you want your pup cup? Okay, there you go. Oh yeah. Is that good? All over your lips. Oh, we love the pop cups. Good boy. Look at that drool. Oh dear.